Welcome to our Fast 5 series in which we touch upon 5 key questions that are on top of investors' minds. In the 6th episode, we welcome Amar Merani, Chief Investment Officer and Head, Real Assets 361 Asset. Hi Amar, great to see you.
Hi.
Thank you for taking out time to speak with us.
Sure.
To begin with, what is the asset class called real assets?
So real assets, as the name implies, basically entails investments into fixed physical assets, ready assets with inherent commercial value derived from long-term contracts. Typically these would be in infrastructure like toll roads, like transmission lines, renewable power plants, data centers, warehouses and so on, or it could be in commercial real estate like offices, retail malls and so on. There's a lot of interest that we are seeing from investors in this space, and the fundamental difference between these assets and financial assets is that in financial assets the value comes from the entire businesses, which the value fluctuates with business cycles, with the state of markets and so on, whereas here it's more predictable, it's more visible, and this comes from long-term contracts in any of these sectors which we've spoken now.
Interesting. What has led to the creation of this new asset class?
So if you look at the last 7 to 8 years, we've seen an investment of about $350 billion in renewables and roads alone across the country, both from the government and private sector. We've seen an investment of about $150 billion in commercial real estate, in warehousing and retail malls. So together about $500 billion has got invested on the ground in India. At the same time, in the last 5 years or so, we have seen 23 InvITs and 4 REITs getting listed. Total market cap, roughly about $40 billion. Total enterprise value, roughly about $60 to $65 billion. So that kind of capex cycle and this kind of listings provides the enabling framework for investors to look at this space in a very attractive manner.
Could you share some reasons why real assets appeal to investors?
Fundamentally, 3-4 reasons. The first and the biggest is that these are ready assets and generate a yield, cash flow yield from day one, which means that from day one you get the cash flow as an investor because there is no construction risk, there is no development risk, there is no approvals that need to be sought because these are ready assets. The second is that the value of these assets is de-linked from the state of the markets, the economy and the cycles, because these are driven by long-term contracts, typically with the government or with MNC clients or clients which are large Indian corporates. The third reason is that there's an element of inflation pass-through that is there in most of these. So in toll roads, for example, you have WPI-linked toll charges, whereas in commercial offices you have every year increases, or every 3 years you have an increase of about 15% or 12% or thereabouts. And therefore there's an element of protection on inflation that investors see in this space. And the last element is to do with tax. So when an investor were to, if an investor were to sell an instrument, say a REIT or an InvIT, there's a very low rate of tax as compared to in the normal private space. So the capital gains tax is typically what is there in listed instruments, which is 10 or 15% that the investors have to bear at that point in time. So because of these 3-4 reasons, this asset class has emerged quite very interesting and popular in the last few years.
What is the difference between real estate and infrastructure investments? And how do you price assets in this exciting space?
So fundamentally not very different, but the biggest difference between them is that real estate entails ownership of the land and the business on that. So therefore, in terms of inherent value, there's a value within the period of let's say 5-7 years that we look at as a projection period, and beyond that is the terminal value, which is ascribed, which is a perpetuity value. Whereas in infrastructure, whether it be toll roads or transmission lines or telecom towers, there is a finite concession period of 15 to 30 years, and at the end of the period the asset goes back typically to the government. So the value, therefore there is no terminal value that is there in infrastructure. As far as pricing is concerned, for infrastructure for example, we look at as is where is basis. So we look at, for example, is it a central government off-taker, and is it a central government-based agreement and concession like say a NHAI or a SECI, or is it state governments? That makes a difference, at least as of now. Secondly, we also look at as is various bases in terms of we look at assets that are there on the ground. We don't consider value coming from ROFO assets, for example. We also don't consider any interest rate declines over the entire period. We consider it as is whereas on interest rates also. So that's a broad framework we follow. And if it is toll roads specifically, then we look at low degree of WPI compared to what normally we see in the market. Whereas if you look at commercial real estate or warehouses, there we look at if we talk about commercial real estate offices, we look at between 125 to 175 bips kind of pricing over and above the 10-year GSEC for grade A office spaces. This pricing obviously would be closer to the it would be finer, closer to the 100 to 125 bips if it has significant mark-to-market potential. Location should be strategic in nature, very good connectivity and infrastructure around it, and obviously the quality of tenants. Whereas if it is let's say a core plus or a value-added asset, then the pricing obviously would the entry cap rate would be that much higher, because there's a lot of work that needs to go into building the asset or putting capex in the asset to make it absolute top of the line, as well as time involved to do that investment. So that's the broad framework we follow for investing into this asset class. And obviously we look at investments into commercial office assets from the point of eventual coming into a REIT framework. So they need to be REIT worthy in nature. That's broadly how we look at it.
Great. What's your message for those interested in real assets as an asset class?
So real assets, if you look at the last 7 years, $500 billion created, about 40 billion listed equity value. Over the next 7 years, the numbers that all of us see is that about $700 billion of investments would just go into two sectors, roads and renewables. About 300 billion would go into commercial offices, warehouses, retail malls, data centers largely. So that's the kind of investments we are seeing. To support this kind of investments, much more needs to be done in terms of listings of REITs and InvITs would happen over the next few years. And even that, if you look at today, for example, the kind of market cap that we have, 40 billion, as compared to India's market cap is about 4.7 trillion. It's very, very small. It's less than 0.9%. If you look at Singapore, this number is about 12.5%, 13%. If you look at US, it's about 2.8, 2.9%. So there's a lot of runway available for this sector to grow as a percentage of the total listed market in the country. Again, if you look at overall stats, we have only 4 REITs listed out of 900 REITs globally. The total market cap of REITs globally is about 2.5 trillion. We are at only 10 billion. So a lot more will happen, I'm very sure, in the next few years going forward. And this is only the start of the investments in real assets.
Thank you, Amar, for this insightful Fast Five discussion. We look forward to hosting you again.
Thank you. Pleasure.